everyone, this is Daniela Cambone reporting from Colorado Springs. Well, folks, I don't need to tell you that stocks are at all-time highs. It's textbook bubble behavior, and it's why my colleague Joel Lippman is stepping forward with the biggest warning of his career. The next crash is underway for a specific reason that almost no one is paying attention to. He's issuing a rare recommendation to put nearly everything into a completely different approach, the one the rich have used to make a fortune in every crisis for decades. It's not gold or anything else you've likely considered. Joel will go live on Wednesday, September 27th with all the details, so you will not want to miss it. Head to September27warning.com right now to make sure you're on their list for updates. Again, that's September27warning.com. It's 100% free. Now back to the Daniela Cambone Show.
Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show. Joined today by my colleague over at Stansberry Research, Joel Lippman. He is the founder of Altimetry. He's also the CEO of Valens Research. His work is followed by close to 50,000 subscribers, read by hundreds of thousands across the world. Joel, always good to see you.
Hi, Danny. Great to be here. Thank you again. Thanks again. Good to see you.
Yes. Well, listen, we got a lot of ground to cover, and you got a lot of heat last time you were on my show, so you know I'm gonna go there. But let's tell the folks the main reason you're here today, and we're gonna talk about it in a bit. But you do have a big announcement you're making tonight. Can you give us just a little sneak peek?
Yeah, we're
what we can expect.
Yeah, we're releasing both our latest research about why, well, I'm so long-term fundamentals of U.S. equities and the U.S. economy are still very, very, very strong based on the data coming out. Whereas on the short term, we've probably never been so bearish. And so for the next 12 to 36 months, we're really concerned about U.S. equities. We're going to release the data that's showing that and why we're so concerned. In fact, I go so far as to say we've never been so bullish long-term and so bearish short-term at the same time. And so that's part of it, and for a lot of reasons.
So let's talk more about what makes you so bearish now. And I also want to bring this news item that just came out. Jamie Dimon warning that the Fed is not done raising rates, and in fact, the Fed could be raising them sharply. Now, this is opposite what the Fed is telling us, that they're done. They're close to the end of their tightening cycle. I mean, who do you believe more here? The Fed that's in the room where it's happening, or Jamie Dimon? I mean, why is he coming out with this?
Well, we do this audio forensic analysis, and one of the things we do is we do the calls. And while Powell talks about taking a pause, and he is taking a pause this quarter, he's still super, super focused. His emotional affect when he and the Fed talk about a 2% target, all right, that 2% target is so concerning that as long as employment isn't an issue at all, and unemployment stays very low, which is their biggest concern, they're very, very close to biggest concern, inflation, I think they will do everything to get down to 2%, which means keeping rates at this level for a longer period of time. And if they have to, if they still see inflation showing up in a lot of areas of the economy, they may still raise rates on top of where they already are. So that is concerning for us for the short term. And it's one of the reasons we have such a bearish look.
So what do you say when a lot of economists come out saying the only way for the U.S. to get out of debt is with high inflation? So this, this charade or mirage of the Fed fighting inflation is just that, a mirage that they don't want to almost.
I would suggest to you those are accountants, those are economists who don't understand tax accounting, who do not have accounting background. If you understand tax accounting at deep level, someone on your show recently said, hey, there's $7 trillion of U.S. debt that's coming due this year that's going to have to be refinanced at these super high rates. And I said, well, why don't we just do the math? Why don't we do the math on that? So it's $7 trillion. All right. At what rate? All right, 5%. So what's the cost of that $7 trillion at 5%? $350 billion. That's against a tax base of $5 trillion that the U.S. is collecting. So in a lot of parts of the world, they are over indebted. They have too much. Look, I don't want the politicians, the absolutely irresponsible politicians, hearing what I have to say, because I don't want them taking out any more debt. But at current debt servicing levels, the United States does not have a problem. And I mean at the current debt servicing levels, including refining at these super high rates. So when you start doing the math, right, a lot of people are, these economists saying, oh my goodness, we need inflation so that the cost of debt actually comes down or whatever. I'm like, no, you look at the budget, you look at the $5 trillion in tax revenue the U.S. has collected last year, that the U.S. will collect something close to that, 4.5 to 5 trillion, maybe more this year, and you compare that to servicing, a debt of 350 billion. I mean, if anything, maybe the 350 billion crowds out other spending the government should not be doing. But the fact that, does the U.S. have enough to cover its debts? Yes, we do.
So,
I mean, easily.
Joe,
easily.
why don't they deal with it then? Then deal with the debt, make it go away. If they can clear the debt, right? Like look at the debt ceiling, right? Why do they keep kicking it down the road?
Yeah. I'm not saying that the U.S. has the capacity to pay down the 30 trillion. I'm saying they have the capacity. The U.S. has the capacity to service the debt on an ongoing basis and just keep it at that level. If the dollar amount of the debt and the debt service increases only as fast as the U.S. economy and sustainable taxation of that, I'm just being very specific. Where do you get the money? You don't pay money. They talk about GDP all the time, the BRICS with GDP and everything else is GDP. GDP is so big in China. Countries don't pay their expenses or pay down their debts with GDP. They pay it down with sustainable taxation. And the U.S. actually has it. On lower tax rates than most of the world, the U.S., most of the big countries in the world, the U.S. is collecting a much, much, much higher tax revenue amount, which means it's sustainable, which means it can continue to service the debt. That said, there's no reason to take the 30 trillion down to 20. The idea is to not let it grow any faster than the ability to service that debt grows. And that's basically what the U.S. economy or what U.S. taxability grows at.
So, Joe, let's hone in on the U.S. dollar, because the last time you were on, you were the great defender of the dollar, true patriot, and you took a lot of heat for it. Now, I will give it to you that since that interview a few months ago, the dollar has held up. The dollar has held up. So you are right. But the question is the dollar just holding up because it's the best house on the block, or is there more to the story? I mean, why is the dollar still so powerful?
Yeah, there's a couple things. One, our data and our work is showing that the dollar will remain the reserve currency for the next decade. So whatever happened in the last 6 months, nice, but I'm not trying to take credit for it, nor should we be giving any credit for such a short-term move. I think the dollar over time will continue to get stronger than other currencies, given, frankly, the Fed's all-out fight on inflation, which essentially strengthens the dollar. The idea, though, that the BRICS are going to come up with anything anytime soon, right, and all the additional BRICS, throw all the rest of the BRICS in there, whoever you want to call a BRIC, and say that they're going to be able to come up with reserve currency first. The idea that China and India will ever agree on giving up either's own influence over their own currency is just ridiculous. They're in armed conflict right now. I mean, we talk about China drawing the old 9-dash line and 10-dash line, which says here's a territory that we own. I don't know if you've seen the latest China map, the official map of China put out by the CCP, and it's showing all kinds of pieces of Russia and India that they say belongs to them. Meaning, oh yeah, we just changed our borders and this belongs to us. These are heavily disputed areas, and yet they're all going to agree on one currency and suddenly have that? No way it's going to happen. The second thing that people talk about that is just so troubling is this idea again that GDP is the all-in measure. GDP only measures volume of transactions. It doesn't measure quality. It doesn't measure ability to innovate. It doesn't measure tax sustainability, which is what governments run on, sustainable taxation, not on one-time hits of raising taxes because they just steal money from their population or whatever else. So no, as long as the U.S. corporate earnings are bigger than all of the world's corporations combined, as long as U.S. bond issuances are bigger than, frankly, all of Europe and probably Asia, I'd have to look combined, but definitely more than all of Europe combined, the U.S. Treasury being the safest place still to this day, despite what a ridiculous credit agency might say that the U.S. isn't AAA. If the U.S. isn't AAA, nobody's AAA. So why even have the rating? Why even have the rating, right, to say who's AAA? So the fact that the U.S. is the safest place to park your money, the U.S. stocks are the best place to generate dividends or capital gains over the next 20, 30 years, right, that innovation and innovation spend is better and heavier in the U.S. than anywhere else, which guarantees that this will stay the same way in 10, 20, 30 years. It's that current innovation that's going to do that. The BRICS are who again, right? With what power? Other than the fact that they have a lot of transactions and volume. Meaningless.
Okay. Hold up. A few counterpoints there for you. Okay, so getting back to your point about how, China, definitely, I'm sure they don't like Russia nor India, but the common denominator of the BRICS is that their disdain for the U.S. outweighs that, Joel. So don't you think cumulatively they do want to take down the dollar? Even if they hate each other amongst each other?
Absolutely they want to. Absolutely they want to. But will they give up their own sovereign rights to each other? I mean, my goodness, if you're going to give up any amount of, you are giving something up if you're a country and you say, I'm going to, rely on the reserve currency being the U.S. dollar. You're relying on the U.S. But that means you're relying on a rule of law that China and Russia and Saudi Arabia do not have. You're relying on
wait, Joel.
Sorry, yes.
Joel, the euro.
Yes.
We saw it in Europe. Why couldn't it happen amongst the BRICS? They gave up their sovereign power.
Yes, and look what's happened to the mark in Germany and the cost of inflation to Germans, right? A cup of Starbucks doubled in price almost overnight and never came back down again. I don't think there's any way that these countries have seen what happened to the countries that really took it on the chin by saying we're going to move to the euro. Look at what happened from a cost standpoint. And so it's interesting that the European nations were able to do that with Germany really leading that. But no way that India is going to give up their influence over their own currency to China or vice versa, right? Or to Russia, right? Or to Saudi Arabia. It's a lot of talking about, hey, what can we do? And what you're going to find is they're not going to be able to do anything, right? Nothing.
So what do you think is the point of these? What are they trying to do then? If you think at the end of the day, push comes to shove, no one's going to give up their sovereign rights, right? What are they trying to do with these BRICS meetings that obviously cost millions of dollars to put together here? What are they trying to do? Is it just an image play? It's just a PR stunt?
Well, I don't know that any of these politicians running these other countries are much smarter to realize that until they get together in a room and go, oh, wait a second, to make this work, I'm going to have to give up, India's going to have to give up its power over its own interest rates and whatever, and amongst the fiat currency to something China's going to say. I think China was hopeful they'd be able to do something because they think probably that they can, along with Belt and Road, they can begin to have a much, much, much larger influence than they deserve, than the CCP deserves over all these other countries. I think they're hopeful that they could do it. But at the end of the day, there's no way you're going to have Russia and India and China and Saudi Arabia even agree on, I'm going to give up my fiat currency's influence to some consortium. There's no way China's going to give that up. It just isn't going to happen. To a consortium, no way.
Now Joel, you might say, okay, BRICS, who, and what, who are they again, and whatnot.
Well, we know where they are. I'm just making fun of the idea. That's all.
I know. But are you not looking at the growing power? Look at the energy dominance of this group. Is that not concerning? From an energy standpoint, they are the largest consumers and producers of energy, and now they're working together.
They have been working together under OPEC and under OPEC Plus, and despite that, we saw oil go to zero not many years ago. Zero. Right, that oil went to. So yes, they have this band together, and then suddenly, and this happens even under OPEC and OPEC Plus, right, that some country really needs the money, and they just start dumping, right? They just start dumping. At some point, Russia in such deep trouble right now, right, in terms of needing money. At what point does Russia just say, we don't care if we reduce prices globally, we're going to have to start selling to anyone and everyone as much as we can because they're running out of money. Right, every day. Their tax base is gone to near zero for income taxes on corporations because companies aren't making money there. Their individual tax base took a big hit when a couple million of their highest earners left and a few of the oligarchs left. It becomes harder to get that money back, right, from a taxation standpoint. I'm not saying that Russia won't be able to just take money from people. I mean, they've been good at that. It is a communist country after all, right? Same with China. But that's not sustainable. It's sustainable taxation for the U.S. over the long period of time. And so at some point, Russia could say, you know what, we need the money. Just like many other OPEC countries, despite being in OPEC Plus, have done. And when that happens, oil goes back to some really, really cheap prices. So yes, it's interesting and it's concerning that we have to watch. But this is a different story. Talking about OPEC Plus expanding to the BRICS, I think is a different discussion, which I'd be more worried about than the BRICS creating a new currency that will replace the dollar. All right, one is more concerning than the other.
Let's bring it back home to the people in the U.S. I was just speaking to some investors yesterday saying, Danny, they watch the show and they're saying, everyone's talking about the strength of the U.S. dollar, but everyday folks are not feeling the strength of the dollar, right? They get to the register, and yes, we could talk inflation and whatnot, but they're not feeling this almighty dollar, Joel.
Yes, and that's an issue. Meaning, that's an issue for relative inflation, and I am concerned about inflation in the U.S. Not as concerned because of QE, but more concerned because of supply chain issues, right? China's problems and the need to restructure and resupply the U.S. around the world takes time, it takes effort, and it does lead to a costlier base over a long period of time, right? Because, when China is able to just steal IP left and right from the whole planet and pollute the world as much as they want, right? And then have, no shortage of labor issues and labor problems, or getting, frankly, cheaper labor than they ought to, given human rights issues and everything else there, and I'm talking about the Uyghurs and others. Well, of course they can produce cheaper goods than the rest of the world. So if we're going to stop allowing this outright taking of IP in China, if we're going to stop allowing outright pollution, unbelievable levels of pollution, right? You want to stop pollution in the world, you stop China's factories from polluting, right? And human rights abuses, which means you have to actually pay people a living wage and whatever else. Well, of course things are going to get more expensive, right? And they'll get more expensive. That doesn't mean the dollar doesn't remain the reserve currency. It just means things will cost more. And it isn't necessarily because the dollar is, quote unquote, losing value. It's because we're having an extreme supply chain shakeup, meaning in this, frankly, they say it's deglobalization. I don't think it's deglobalization. It's de-China. It's less China. It's all world, less China. And that will be more expensive for the rest of the world. And frankly, the world without Russia's fuel, right, and without Nord Stream in place, and without Europe getting all that gas at a very cheap level, also makes things more expensive, right? So there is a reason for the costs to be rising, and there is a reason for someone to say, I feel it. That isn't necessarily because the dollar is devaluing wildly. It's because there are supply chain issues and shortages, because people actually do want to say, I'm willing, it seems anyway, I'm willing to pay more. Maybe not everyone realizes it, but they are saying, I'm willing to pay more. Stop letting China steal IP and pollute and treat, humans in such a bad way, and let's improve these things, which means we start having to get our supplies from other countries, which means it'll be more expensive, albeit maybe with, more sound and sustainable and sensible production.
Joel, you also mentioned the downgrade. I never had a chance to ask you about that because it happened after you came on the show. Yeah. Just your thoughts when you see these rating agencies come out, and it was such a big news headline that the U.S. had gotten downgraded, but you say, who cares to the ratings?
Well, you chalk it under the same pair of headlines as saying the S&P is going to go to 50,000, or Bitcoin's going to go to $1 million. Right, or the U.S. credit is collapsing, and we better start downgrading the credit rating. It's a headline. It's meaningless. All right, it's meaningless.
Short term, let's get back to this thesis of you being bearish. Now, what does that mean? You're out of U.S. equities?
No,
completely now.
So this is the problem, because people are asking, should we be shorting U.S. equities? And I said, well, the issue is, what if the U.S. just goes sideways for 2 or 3 years? Which is possible, or it's only down a couple percent for 2 or 3 years. Not to mention what exactly you're shorting. Shorting costs money, right? It's not like buying stocks. Shorting stocks, you actually have a daily cost or a monthly cost or whatever. And so, I don't know, shorting and just making that bet is a tough one. What we're actually saying is that we think we're not going to see giant 20, 30% runs like we have been seeing, like in the post-pandemic year, and even in the first 6 months of this year, we're not going to see that kind of performance. and that you really, for any riskier stocks you're in, it's time to start moving out of those and into other securities that do well during these sideways to down to bear market areas, and that's what we're releasing for our research tonight.
So yeah, like I said, you're going live, and if folks want to watch, they just have to go to September27warning.com. Again, that's September27warning.com. Yes. So tell us a little more about. I mean, I know you can't reveal too much right now. You have to tune in, but what would we learn, and what would we be armed with?
Well,
that we could go, back.
Be fearful when others are greedy. And so what is greed? Greed we can measure in terms of sentiment, right? A number of sentiment indicators right now are at 10 to 15-year highs. I mean, concerning levels, right? And then you look at certain other areas of fundamentals of companies. We're not saying that we're going to have widespread bankruptcies like 2008, but you are going to see earnings erode to such a degree that these downward earning revisions we're already seeing, we would expect to continue because of certain signals we're looking at. And the latest of those signals is what we're actually releasing, not just the signals. So both of what we're doing tonight is both releasing the latest research on why we think the market is really topped out and we don't have much elsewhere to go. And then we're also releasing the right investment strategy that we see some of our clients. As you know, 230 of the biggest 300 money managers in the world are reading our work. And when we look at some of the strategies that the best and smartest of our institutional clients are getting into, we start seeing a trend towards an area, and we said, well, let's release that research strategy, that investment strategy for people. And so because I have to release it all at the same time, I can't give you any more, Danny, than that, but we'll be showing. Yeah. The hint is it's not stocks and it's not funds. That's not where you're going to find the right returns.
I'll definitely be tuning in, September27warning.com. So let me ask you this, because the last time we were on, you thought we were heading into a mild recession. Has that forecast changed at all for you, Joel?
No, we fully believe in that mild recession. The issue is, and here's where things have come up that are different. That we made a big long call on the markets. One, we thought the markets were toppy because of many of these sentiment indicators at the beginning of 2020. But then when the market collapsed, we're unbelievably bullish. You can look it up in my LinkedIn and even in Forbes. In March, April, May, June of 2020, we were saying buy the market because we were seeing good fundamental signals and relatively low valuations. Right now, we're seeing the same kind of toppy indicators we saw at the beginning of 2020. At the same time, we're not seeing some of the other stronger fundamentals that we saw at the bottom of 2020, which says we don't expect earnings to be revising upward. We expect to be rising downward. We don't see a surprise. The U.S. economy and the U.S. stock market are not the same thing, but this is one where they line up, and where a recession in the U.S., even a mild one, means not good things for the U.S. stock market in terms of how it could either roll over big time, if not just maintaining sideways and doing nothing for your money over the next 12 to 36 months.
Joel, what's your latest take on gold? Do you like it a little more?
I think gold is great for crises, but we already have a certain amount of crises, meaning Russia, Ukraine, but that's been going on. So whatever's that issue is priced in. I don't see China finding a reason to invade Taiwan. What would they get out of it? I don't know what they'd possibly get. I do consult and advise the Pentagon regularly. I don't see how China benefits from Taiwan. I know people say that it's a diversion from all the problems going on inside. Now, invading Taiwan create even more problems inside China. Inside China, we have more problems from an invasion of Taiwan, not just it being horrible for Taiwan. So, no, I think at the end of the day, gold is a trade on new crises and big ones, which I don't see happening. Not that it couldn't. Then gold's a great trade. But as a long-term investment, you'd have to believe that the Fed's going to bring interest rates back down to half of where they are now or less, and the dollar stops getting stronger. I mean, I don't see gold as a terrible place to put your money in terms of if you want something against inflation. But over the long period of time, or the next 10, 20 years, U.S. stocks will do very, very well. Gold may not be a bad place for the next 12 to 24 months, but I think there's better strategies. That is what we'll be talking about, that we see our clients, our biggest institutional clients getting into, that's better than gold.
Let me, like what?
I think there's certain areas of credit, and I think there's certain areas that are not bonds but security specific that I can see our clients moving into, and they don't share that with the general public. They just don't. And one of the things that we did at Altimetry was, you said, it was a great business for many years, making the richest of the world, helping them get richer. It's another nice thing to have literally tens of thousands of subscribers through Altimetry, where we share some of that best institutional knowledge, and that's our reason for being. And I got to tell you, it's a lot more exciting and fun to help individuals and families than just helping the richest of the world get richest. Not a bad business, pays the bills. Not as much fun though necessarily.
Let me just ask you this. Let me just wrap on this point. You're obviously not fearing a future BRICS currency of whatever sort.
No.
What are your thoughts on central bank digital currencies? Is that a concern for you?
Well, I'm concerned anytime the government tries to do anything, any government in the world tries to do anything that starts monkeying around with money, meaning I like to see this take a long time. I like to see them be very careful about what they're going to do. I like to make sure that they build something that is not hackable, which I don't trust that each individual government could do something like that. So I'm hopeful that it'll help create a digital dollar in the U.S. that will help smooth and grease the skids of commerce and exchange of money, and maybe even add some privacy element to it. But again, it's the government we're talking about, and while I'm very bullish on the U.S. economy, I'm not. That doesn't mean I'm a fan of the U.S. government or U.S. politicians by any means. And I want to see what the politicians are going to do and how they're going to do it, because that central bank digital stuff could be as scary as anything, right? I mean, the whole point of crypto is to be decentralized. So you're calling it a centralized, decentralized currency. Well, what does that mean? And until we see it happen, how can I make an opinion other than it sounds fishy?
I always love chatting and catching up with you, Joel. Joel Littman of Altimetry. Good luck tonight
thank you.
On your event.
Yeah, please tune in.
Break a leg.
Hope you'll enjoy it.
You always kill it. And I hope everyone tunes in, because he's the best. Joel's the best. We might not agree on everything, but I still listen to what he has to say. So it's September 27th warning.com. Again, that's September27thwarning.com. That's it for me. Thank you so much for watching. Thank you, Joel. And be sure to stay tuned to the Daniela Cambone Show and sign up at danielacambone.com. That's it for me.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.